Welcome to the Market Snapshot. This is Dan French from Nova Home Loans. And I'm here today with Chakits Krulsawat, again from Simply Vegas. What's going on today, Chuck?
I'm doing good. How you doing today?
I'm doing great. Also, we have a special guest again, Greg Sinacori from Kilburn and Lein CPA. Greg, what's going on today, Greg?
Well, it's Happy Father's Day out there.
Yeah.
Happy Father's Day to all the fathers out there on the radio. And it's good to see you again, Dan.
Yeah, I appreciate that. And, you know, like he said, Happy Father's Day. Anybody out there that's a father, hopefully you're having a good day with your kids. We have a great show today. And as always, it's a pleasure and a privilege to educate the Las Vegas community here. Right, Chuck?
That's why we do this 7 days a week, nonstop.
We have a lot of news and events going on. And I want to talk about that. Chuck, what's going on with some of these news and events here?
EDC, Electronic Daisy Carnival. More than 400,000 people will be dressed in colorful clothing.
Whoa.
Dance, music, electronic music. Over 20 DJs out there. Tickets are selling for about $700. Okay?
Really?
Out at the Motor Speedway.
I need to get my glow sticks out. Also, jumping over to the housing news, we have luxury home construction. This was not something that was big, but it's starting to come back around. And what I've looked at is there's been a lot of custom homes being built in the Azure area or location.
Yeah.
They have a big, hit with this right now. It's built along the Jack Nicklaus Design Golf Course as well, nestled outside Red Rock Canyon. And we've seen a big influx of this. More than 20 custom homes are being built in Azure right now, which sits inside the ridges. Yeah. And this is one of the wealthiest, most exclusive areas of Southern Nevada. Also, a number of new homes are said to be with these custom homes, about 7,000 square feet. And the cluster of construction makes it a little, it's like a little bit of a tract subdivision, if it looks like. But what they're doing instead is they're trying to really create a custom environment instead of having these cookie cutter homes that's out there. And, that's a good thing.
Greg, don't you have a home out there being built?
No. I'm a CPA.
Oh.
All right. Also, there's developers sold right now 21 new homes for at least $1 million or more this year through May. And that's up 34% of sales last year, which was in, just in 2013 and 14, according to Las Vegas-based home builders research. So those numbers are increasing. Yeah. And, it's a good thing because I think, like we talked about in previous shows, if you want to get that backyard or you want to get something that's, more towards your liking, really, then you're really going to have to pay for it. You're going to have to pay more of a premium. And I think you're going to start to see that more where, a lot of these people that are going out and buying new homes now, they don't have a big backyard.
Can you finance a custom home?
Yeah. There's no reason why you can't. Okay. It's just it's a jumbo loan.
Okay.
So, yeah, I mean, we have tons of options for that. But, again, if you're going to go out and get one of those cookie cutter homes that we talked about, there's no backyard. You're going to be walking outside and going, okay, that's it. And then you have to come back in and go, okay, where do I go get a custom home at?
Yeah.
I got to put that money down. Also, we had a change that's going on. We've been pitching this since the beginning of the year about CFPB. And CFPB was Consumer Financial Protection Bureau. They were putting out what's called TRID disclosures. Okay. And this is a change that's going on with the financing world where you're going to have to change the closing disclosure. Really, it's going to come into play here. They were talking August 1st, but there's a lot of indication that even if they tried to do it August 1st, it was going to be pushed back because there's still some things that there was some clerical error. Yeah. So now they're talking about pushing it all the way back to October 1st, where this is not going to come into effect. Now, it's not passed legislation yet, but it is there, and they are talking about it. And I think it's going to go because I don't think most mortgage companies are ready for this 3-day delay before it actually gets to closing. They don't have all the things that's in place that's needed for all these, really the disclosures of how they're presented. It is a different process. And anytime you go into a different process, you got to realize it's affecting everybody, the title company, it's affecting the real estate agent, it's affecting you as a loan officer. So it's affecting
the buyer,
everybody. It's affecting everybody. And for everybody to be on the same page to meet those close of escrows, they really need to make sure this is fine-tuned and put into place at the right time.
Gotcha. Now, for the buyers out here, I mean, how does it really affect the buyers?
Well, if you look at the buyer's side of it, if you're a buyer and you say, well, I'm going to write a contract.
Yeah.
It doesn't affect the buyers other than the fact that they have to look at it and they have a chance to now review it for a longer period of time before they're going to say, yeah, let's go ahead and go forward. And I think it's just another way for the client to really see what's involved on your loan and what you're paying and the true cost of what you're paying on your loan. So I think it's going to be beneficial, but I don't think they're ready to put this in place yet, because this is a big change. Because like I said, it takes everybody, all parties, to get on this. Yeah. And if you don't have all parties connected, you're going to have a problem.
So this was actually put in place for the consumer, so they can actually read the forms and really understand what's going on and where all the money's going. Is that correct?
Yeah, it's really, in my opinion, there's changes that go on. You know, if you're changing, you know, let's say you have a change that's going on during the course of those 3 days. Yeah. And there's really 3 changes that go on. There's an adjustment to your APR, change in, you know, product or pricing, if you want to say. Yeah. You have to redisclose, and then it's an additional 3 days after. So what it gives to a client or the consumer is it gives them time to review. Yeah. And it really makes them say, you know what, either I want to stick with this loan or I don't. But this is a big deal because this has been started. I mean, we've been talking about this since, I think, March, you know, and I think because this is such a big deal and because it does take a lot of time to get things like this in place, it's going to happen in October 1st is what I believe. It's not been passed yet.
2017?
Yeah, I mean, a year and a half from now, we'll be ready to go.
Just kidding.
But undoubtedly, this is going to be a big change. Yeah. So everybody needs to stay.
For the good, though.
It is for the good. Now, I want to say this. It's important you stay tuned into this show because we're going to be giving constant updates, not just on that, but anything that's pertaining to financing real estate. These changes are going to occur. You got to listen to the show, so that way we can tell you when it's going to come into effect. Yeah. That's very important. You ready for the market rundown?
I'm always ready.
As always, we start off with the housing market statistics. We go right into interest rates trending. We're going to talk to Greg Sinacori here from Kilburn and Lein CPAs. We're also going to go over some zombie foreclosures and finish it off like we do every week, Chuck, with the lender versus realtor face-off. You ready for this?
Let's do this.
Let's do it. And if you have any questions regarding the show, you can call us in studio at 257-5396. You can also schedule a free 30-minute consultation outside studio at 781-6682. You can also go to us and tweet me at 781NOVA. And Chuck, I really want to push the website. This website's really starting to morph into something really good. Tell us about it.
781nova.com is an all-in-one website. This website provides educational videos, past shows, weekly market statistics, selling, buying, and all loan programs.
There you go. Also, we're going to give away a free lunch for 2 to PF Chang's.
Free.
What do you think about that, Greg?
Free is wonderful. I love free.
You're going to hear some more free stuff later down on the road here.
Can we write that offer?
Well, that's going to be an advertising cost for you guys. I'm sure you didn't get that just free. You're going to have to put that down on your tax return.
That's right. I'm also a PF Chang's regular. I'm a PF Chang regular, and every time I go out there, I'm treated like a king there. You know that, right, Greg?
I think you're treated like a king wherever you go, Dan. Every time I'm out with you.
Yeah, rock star status, right?
Rock star status, buddy.
Anyone that has questions regarding the show, financing or real estate, give us a call again. I'm going to repeat this number, 257-5396. Chuck, what's going on in the housing market?
The housing market, this is where we're bringing you play-by-play, week to week. All data was pulled from the multiple listing service, not including for sale by owners or new home sales. Overall inventory has dropped by 1.7% in addition to a 13.8% decline in home sales. We currently have 9,709 properties currently listed on the market today. 86.6% are actually traditional sales. 10% are actually short sales. 3.3% are actually bank owned. The total inventory we have right now is a 4.5 month supply. Okay. Now on the rental side, the rental market has increased by 1.1%. Rental lease agreements that were actually executed up by 25.4%.
What does that say? There's more renters right now?
A lot of people are renting homes. Okay. And the problem is that, you know, the homes out here in certain locations are still fairly cheap. And it's making sense for investors to get about anywhere from a 6 to 8% return. And investors are pulling the trigger. And what they're doing is they're putting the properties on the market for rent. And they're keeping the rents pretty low. But keep in mind, it's case-by-case basis. So if you're thinking about, you know, buying a home versus renting, you got to give us a call because it may be cheaper for a mortgage than to rent.
Yeah, and I want to say one thing about that is there's going to be at some point, we're going to have to look at the idea that, well, rates are up so much or they're going up so much. Yeah. There's going to be a point where now it's a preference to buy a home.
You're right.
It's not there yet. But you know what? At some point, you're going to say, well, mortgage is the same as what this rent payment is.
You're right. And we talked about this last week as far as purchasing power. Is the rent, as the interest goes up, you're going to lose that purchasing power. And you don't want to be left on the sidelines or left behind.
That's right. Okay?
Now, I actually did a report on price appreciation for May of 2015 versus May of 2014. The highest zip codes was actually 89169 and 89119, up 27%.
Wow.
It's actually located over here by UNLV and also the airport, which is probably less than half a mile from the Las Vegas Strip. So I did a little bit more digging to see what's going on in this zip code and see why is it appreciated so much.
I know why.
Tell me.
Because you can jump over and watch a basketball game and then jump right back home. I would do it.
There's 197 properties currently listed in the zip code. The average sales right now is $131,000 at $91 per square foot. That's actually listed. The average sold is $128,000 at $88 per square foot, and average days on the market 62 days. Remember, you know how we had this discussion where the average homes right now is at 215, and we just talked about this where if homes are below that price point, it may be good to rent at that time because of the price point. So I think that's the reason why a lot of investors are actually flocking to the zip code because it's next to UNLV, it's right next to the Strip, and they're actually getting their rents what they're looking for. Now, the last 90 days, there were actually 147 properties currently listed. Okay,
wow.
52% in that neighborhood were actually cash investors.
All right.
2 bedrooms, 1,000 square feet, rents for about $850 a month, an average of 20 days on the market for rentals, gives you an 8% return on investment. Okay.
All right.
Now, the lowest zip code, 89118, dropped by 36%, located on the west side of the 15, which is that zip code is right next to the zip codes that we just talked about.
Okay.
Okay. There's really not that many homes out there, but the average homes are about $500,000.
If you said, is the median price going to go up from here? Okay. You don't have a crystal ball. You obviously see a lot of homes being built, new homes being built.
Yeah.
Do you see that increasing?
My personal opinion, no.
Okay, so you think we've kind of flattened out here a little bit?
Well, what's taking place right now with 2006 coming around with the elections, you know, with all the HELOCs coming due, I mean, I think we're kind of getting stagnant right now. But if your home is priced correctly, it will move within 30 days.
Okay.
What you got going on with the interest rate trending?
Interest rates trending. Okay, mortgage bonds finished the week higher, which pushed rates lower. Remember, a lot of times when bonds finish higher, it really helps rates because the yield is lower on this, and the trading was volatile on mixed data. The NAHB Housing Market Index, which is the National Association of Home Builders, printed above expectation at 59 versus the expected 56 mark. This did affect rates, and it was actually something that indicated that rates were worse at the beginning of the week, but they did respond good because the Fed came back and said the U.S. economy hit a soft pitch earlier in the year, which really what that says is that there's a periodic, or not a periodic, but a period of weak economic performance. And it's a trend of economic growth during this period. So central banks cut interest rates in order to encourage growth. So it still looks like we're trying to encourage the economy for growth and improvement. So it did help rates. So what happened is by the end of the week, we finished this week, which is good, about an eighth of a point higher. And I'm really excited about that because I think it's giving us a little bit of a break.
Yeah.
You know, every week it's like, okay, they're going up, they're flattened. Well, guess what? We got a little bit of pricing last week. So if you're out there and you're looking to refinance, you're still in a position. I mean, you're right there on the fence, but you're still in a position that you might not be able to. Let's say you come a couple months from now. I don't know where it's going to be, but right now it does make sense in some, situations. I just got a FHA Streamline refinance that I did, and it made perfect sense. They're cutting their, insurance down by 40%, and they're lowering their interest rate still. But if you're, in the high threes, around the 4%, you're not going to save anything in rate typically on an FHA Streamline refinance. So what I'm saying is you really got to look at your options out there. You got to exercise whatever's out there. If you're looking for buying or you're looking to refinance your home, give us a call again outside studio to schedule that free consultation at 781-6682. Let's go over and talk to Mr. Greg Sinacori from Kilburn and Lein CPA. Greg, how you doing today again?
I'm doing good today, Dan. It's nice to see you. And yes, there are a few things we could talk about here as far as you've mentioned that there's still short sales out there.
Yes.
The cancellation of debt issue still is lingering out there.
Yes.
We do not have for 2015 the qualified principal residence. That is hanging out there for an extender bill. So that's on the fence. So anybody that's possibly in that short sale realm of their principal residence could not, it may not be good news to them.
Good. All right.
But
so let me ask these questions. So I have some questions and we'll talk about it a little bit, and you can elaborate too, because I know, you've been doing this a long time. Tell us a little bit about yourself and how long you've been doing this.
Well, I've been with Kilburn and Lein CPAs since 1995? Yeah, 1995. So
Chuck,
this is like my 20 years will be this year.
I don't think we were born yet, were we?
What were you, like 6?
I think so.
But yes.
I think when you started, I figured out how to write my name.
Ooh, man. The gray hair is prickling up on the back of my neck.
So let's talk a little bit about 1031 exchanges. Now, you said you've seen there's an increase in those, right?
Well, I haven't had a 1031 exchange in, I'm going to say, probably 6 or 7 years.
Okay.
And I had 2 of them with investors this year. They were moving from rental properties, which they bought here in 2008, 2009, 2010. And all of a sudden, one gentleman who had accumulated about 22 doors, he now has, he got rid of 4 doors, and he is doing 1031 exchange in that he bought those properties low in the downturn, and now he sold them at a decent price, kind of like what Chuck was talking about, that these homes underneath that 215 mark,
right?
But they're up selling 150s, 160s, and they were selling down around 100.
Wow.
In the bad times that we had.
Right.
And so he had gains there, and he has sheltered those gains with a 1031 exchange.
Can you elaborate really quickly? What is a 1031 exchange for the listeners out there?
Yes. On a 1031 exchange, you're trying to not have to pay tax on the gain. So if you've got gains built up, you're going to sell this property, and you know that you're selling it. Well, you then, if you sell it, you've got 45 days to recognize another investment property that you're going to buy, and then 180 days to close on that. And if you do that and the first property sells, the gain, all the money stays with an intermediary. And then you recognize the new property and close on it. Well, any gain from that first property rolls into the new property.
So you're deferring the taxes.
You're deferring having to pay taxes on that. That's correct, Chuck. You're absolutely right.
All right. So if you look at, there's some big things that when you look at schedules, now there's a lot of people that go file tax returns and they just say, I'm just going to do the 1040 easy. I don't want to deal with it. But if you're somebody out there that is a business owner or somebody that does file tax returns and does need help on maybe, I'm not going to say write-offs, but when you have corporations and you have, Schedule Cs and you have things like partnerships, what is the difference in schedules that are in a tax return for our audience? Okay.
For the 1040, we'll just kind of hit on, the schedules that are in the 1040 behind the main 1040 tax return. The first schedule is that Schedule A.
Okay.
And this is where your new home buyers that have that property taxes for the first time, or that they have the property taxes. Sorry about that. They have the mortgage interest.
Okay.
This is where they're going to take that deduction, is on Schedule A for those. And once they start itemizing with property taxes and mortgage interest, then other things come into play, like the registration on their vehicle and sales tax that you pay. That because we have no state income tax here,
okay,
we get a deduction for our sales tax on that Schedule A. So when you have that new home buyer, not only are they getting a deduction for the interest and the property taxes, but there's other things that come into play all of a sudden for them that they may not have been aware of before.
What about like home improvements and stuff?
Well, the home improvements and your new home buyers really need to keep track of those because they start to accumulate. You know, they've got their landscaping, they may change out the flooring.
Right.
All these things add to the basis of their home for when they go to sell their home.
Mm-hmm.
So they need to keep a list and invoices, maybe take some pictures even that, hey, when I go to sell my house, I need to remember not only did I pay $250,000 for it at closing, but I put in those floors and that cost me $15,000 for wood floors,
Right.
or I put in window coverings. They're going to have to, they got to come up with that stuff. Especially, I don't see it right now, kind of like Chuck was saying, that median home price moving up. But I think here we are getting to a better place in this housing market, and the prices are ratcheting up a little bit. And people are going to start having gains.
Yeah.
In the future.
I agree with you. And, like we talked about before, sometimes it takes 3-4 months for people to get into a home. And what I approved them before, it's not saying that they can't, but guess what? Now the price home that they're looking at now that they're making an offer at, they come back and say, hey, I got an offer accepted. And now their payment's a lot higher because those increases just slightly, but those increases are showing and they are occurring. So I agree with you.
Yeah. So they need to keep track of those improvements. Good point.
So
Chuck.
when you look at the idea of depletion, depreciation, those things come into play with being a business owner.
Again, the Schedule B would be the next schedule. That would be interest and dividend income.
Right.
We're going to skip past that. We're going to go to that schedule, not even the D where the capital gains are, but we're going to go to the E.
Perfect.
Where the rental property is that you're talking about the depreciation and somebody buys a house
Mm-hmm.
and they're using it for an investment.
Right.
They're going to collect rents. They take all these deductions. They take the mortgage interest on it, the property taxes, the homeowners association fees, the insurance. Some of these things you don't get to take as a regular homeowner.
Right.
So that subtracts down from that rent income.
Right.
Then you have what the IRS has as depreciation. This residential property is going to fall down in 27 and a half years. They're letting you write off any improvements that Chuck was talking about, plus the purchase price of that home, less any allocation for land, and you're depreciating this. Well, your depreciation on a $275,000 home, making it easy at 27 and a half years, well, that's $10,000 a year of depreciation. By the time you take all the expenses, the mortgage interest and insurance and all those expenses, and then you also take that depreciation, well, that can generate a loss for you and offset other income. As long as you're not over $125,000 of gross income, then now you're eating away at that W-2 or the interest and dividends and things like that.
Right.
Yeah.
Does the
Saving you
appreciation
taxes.
start all over when a new buyer buys that property?
Okay, so a new buyer comes in and he buys the property. And yes, he depreciates it at the price that he buys it at.
So it
If he
starts again
uses
with
it
the
as a
27
rental,
years?
He's got another 27 and
nice.
a half years. All of a sudden, the thing's not going to fall down tomorrow, right?
I got a quick question. For like those investors out there, would you recommend them to put the property into like an S Corp or a C Corp, or to leave it as a sole proprietor as far as tax purposes?
As far as tax purposes, the Schedule E is fine for a small person that has 1, 2, or 3 rental properties. They might think about, though, the LLC for the asset protection that it provides. That, hey, if something happens in this, and I'm not a lawyer, but if something happens in this house, a water heater blows up or some catastrophe, yeah, you want that asset protection there of the LLC.
A couple of things here is that when you look at depreciation and depletion, well, we can always add that back for financing.
The depreciation, yes, when the loan officers take a look at it, they say, oh, this is a non-cash item. This isn't coming out of your pocket.
Right.
And therefore they add that back as, and all of a sudden your tax return looks like you made $10,000 more if you had $10,000 worth of depreciation.
The other thing too, as I was going to say before we go to break, is that if you're putting it in an LLC, it's a business loan. It's not a residential loan. So we can't give financing off those if that's the case. But I wanted to let you guys know. We'll be right back. This is Dan French.
Purchasing your first home or refinancing your current home are all major financial decisions that necessitate having the right person on your side. Dan French at Nova Home Loans will work with you from day one to make sure the process is as easy as possible. Contact Dan French today at danfrenchnova.com, or you can call me directly at 702-216-3907. And to learn more about home financing, please make sure to tune into the Market Snapshot every Sunday from 12 to 1 p.m. to find out all the information that's going on in financing and real estate.
NMLS number 369-115. Broker number 0902429.
Welcome back to the Market Snapshot. This is Dan French from Nova Home Loans, and I'm here today again with Chakits Krulsawat from Simply Vegas. And I'm also here today with Greg Sinacori from Kilburn and Lein CPA. How you guys doing today, gentlemen?
I'm doing good. How about you, Greg?
I'm doing just fine now. A little bit more relaxed. You guys are really making me feel at home here.
Good. I'm glad you're having fun. Also, if you have any questions regarding the show, you can call us in studio, 257-5396. Again, Chuck and I push this so we can do a free consultation, 30-minute consultation, by calling us outside studio at 781-6682. You can go to my, you can tweet me, 781-NOVA. And I was going to say, you can go to our website.
781nova.com is an all-in-one website. This website provides educational videos, past shows, weekly market statistics, buying and selling, and all loan programs.
So we're going to go right back in and talk to Greg here about some of these questions that maybe our consumers or our audience have. And Greg, we want to appreciate you coming onto the show. I just wanted to tell you again. So real quick, we're talking about schedules, and we were on Schedule B.
We were on E.
That's right. E.
We were talking about the rentals.
Okay.
And I think we kind of finished that up with the depreciation there.
Okay.
As far as Schedule D, yes, that is where you would report your gain on the sale of your investment property, or if you had a loss on that property.
So really, I mean, it's really pertaining to people that, let's say, what do you typically file for returns? Meaning, let's say if you're just somebody out there that's not a business owner, you really want to look at Schedule A, right?
Schedule A and Schedule B, because you're reporting your interest income.
Right.
Those are the main ones for the general population.
And yeah, go ahead.
But when you do start becoming a business, the second page of Schedule E, that is where you've got your S Corp coming through, your partnership income coming through is on that Schedule E also.
Okay. So if you're out there and you're a business owner and you're writing off income from that business, it's great for tax reasons, but it's not good if you're trying to get financing, because I got to remove that income from you. And I just want to let everybody know that. So really, it's whatever your goals are, but really think about that if you're trying to buy a home, because those losses that you take in a business, even if it's 2106 business expense, let's say you're just somebody that's working at a, I don't know, a hotel, and you're, writing off things like, hey, I got to go get new shoes, cell phones, whatever it is, that cost sometimes, or that write-off that you do, sometimes eliminates you from getting home financing. And you really got to put that in perspective. If you have any uncertainty about this, give me a call. Again, it's 781-6682. Call us outside studio. And if you have any questions, I'll answer those questions. So one of the real questions that I have too here, Greg, is that the 1099, okay, is there different versions of it, correct?
Oh, you bet there is. different versions of that 1099. You've got your 1099A, which is an abandonment of property. That falls back into that cancellation of debt type scenario.
Okay.
Also in the cancellation of debt type scenario, you have the 1099C.
Okay.
And I'm sure some of your listeners and some of your clients have received those, because mine were receiving those, and that has slowed down drastically. But
yeah. So when we talked about the debt forgiveness, is it the
it's the cancellation of debt?
Yes.
Yeah, debt forgiveness. Correct.
Have you seen that extended?
I have not seen that extended yet.
Okay.
We're looking for an extenders bill again at the end of the year. It was extended through 12/31/2014.
Right.
But for 2015, we're out there on the bubble again.
Yeah, and that's coming right from a CPA, because, I mean, I usually get a notification. I don't remember or recalling getting that notification that that's occurred. So I wanted to get it from you. And then guess what? When you get that, obviously you're going to send it to me so I can inform everybody, right?
That's right. You can get it out there on the radio show. You bet.
And does that apply towards your investment property too as well? How does that affect it as far as tax purposes?
Well,
the primary versus the secondary.
The qualified principal residence, no, that does not help out our investors. That they have to rely on that they bought high. If they bought high and they have that high loan, that they haven't over depreciated that property, and now it has a low basis, and they're going to have a high debt forgiveness. If they've been paying down on the loan as the years go by, and the interest has been there, they usually aren't in too bad a shape. But if they
is there a way around it?
Hey, the IRS could be out there listening.
We're just going to write everything off.
Okay, but no, as far as that offset for your investor, if they've over depreciated the property and they've got that low basis, and they had an interest-only loan on this investment property, because they were counting on getting rid of it in 5 to 7 years because the price was going to appreciate.
Right.
We've seen some ugly situations.
So if there was a gap, like a $50,000 gap, they're paying the taxes on it based upon their tax rate. Is that correct?
They could end up having a tax on $50,000.
Chuck,
yeah.
Are you going to punch the wall over here?
I'm good.
Yes.
So if you're somebody out there, and we've talked about this in previous shows, all right, if you're a renter, we always say that it's really good to buy a home because you get that interest write-off.
The interest and the property taxes, all of a sudden other things become available on that Schedule A. That is correct, Dan.
If you have a payment, really, because you get that write-off at the end of the year, I mean, this is the way I would look at it. Maybe some other people don't, but that money that I'm writing off at the end of the year, that's lowering my monthly payment, technically.
It is lowering your overall, yes.
And that's why it's very important if you are renting right now, and let's say if you meet up with Dan and your mortgage is just as even as your monthly rents, remember, you still got those tax write-offs. So at the end of the day, you're still ahead of the game.
Yeah. So when you file those, or let's say when you give somebody that tax interest back to them, is there a process for that?
Okay, that's just part of their tax return. Yes, right. They're going to have their 1040 filled out. On Schedule A, they're going to get those deductions. And yes, that's going to flow, it's usually higher than their standard deduction. So it's going to reduce their taxable income, and they're going to save a few tax dollars. Yes.
All right. And then we got a few other questions here. One of them is, and I want to say this, everybody that has a Schedule C, this is for business owners. Okay. Schedule C, sole proprietor. Correct. You have a partnership. Okay. And you also have a corporation, and there's two forms of corporation, correct?
Yes. The C Corp and the S Corp. So
what we want to know, or let our audience know, is what is the biggest difference between all three of those when somebody files those to you in a nutshell?
Okay. You have the limited liability company, and it can be, you can elect to have that limited liability company be a C corporation. It can be an S corporation. It can be a sole proprietorship if it only has one person.
Mm-hmm.
The Schedule C is, yes, the sole proprietorship. If you're going to be just the sole proprietorship, I would recommend you either be an S Corp or have the LLC protection again for asset protection.
Okay.
And you're just your own business. You don't pay yourself a well, if you're in the C Corp, you do pay a W-2, but if you're just a sole proprietorship Schedule C, you don't have the payroll taxes. You don't pay yourself a salary. You just take profits, distributions of profits, but you have to pay tax and you have to pay self-employment tax. Self-employment tax is the Social Security and the Medicare portion.
Right.
Let me ask you this: how important it is for bookkeeping?
Oh, very important.
And I'm asking you this because we're a C Corp, and it's not that great with me and my wife, and that's my fault. I do apologize.
I'm not going to plug QuickBooks or anything, but somebody needs to, either start a very nice Excel spreadsheet or get QuickBooks going, especially with the C Corp, because you are required to have a double entry set of books.
And that's what I'm using right now, and I found out it to be very helpful. It's just click, click, click. It's very easy.
Yeah. And your CPA will appreciate you doing that.
So we talked about, let's say if somebody won the lottery, we're in Vegas.
Ooh.
All right. Let's say that not the
they
lottery.
Hit mega bucks.
They hit mega bucks. What does that form go under? Just for everybody out there that's that chronic gambler.
You're gonna have other income on your 1040 is going to be a very nice number. You're going to, over on Schedule A, you're going to have any as much gambling losses as you could come up with legitimately. And but yeah, it's going to, you're going to have a good CPA, and you're going to still pay some tax.
So if you win some money at the casino, what's the minimum where they actually, start requesting what you have to pay taxes on? I mean, is it like $1,000 or?
Well, on the slots, a W-2G starts at $1,200.
Okay, so as long as you make under $1,200,
I'm changing professions. I'm going to become a professional slot machine. Button pusher.
I've seen them on there like a church lady on an organ.
You always got to ask this question though, and everybody says, "I won." Well, how much money did it take for you to win that?
Right.
And if you're still negative, you really didn't win.
Right.
But you said you could write that off though, right?
Well, to the extent of your gambling winnings on Schedule A, you can write off your gambling losses.
Wow.
Yeah.
I think I lost about 30 G's.
Well, you need to have some documentation.
You better prove that, Chuck.
Yes.
Well, they better start giving me these receipts at the casinos.
Chuck's going to go to his wife and he's going to have some numbers written down. She's like, "What is this?" "Oh, that's my winnings. Just go ahead and put it in."
Bro, I don't want no investigations taking place, bro. You need to knock it off.
All right, so let's go into any other questions for Greg here, Chuck. Do we have anything else?
No. He was actually a very good
yeah, I just want to say, Greg, I appreciate you coming out. I think you hit everything what we wanted. And how could somebody get a hold of you again outside studio?
Outside studio, Kilburn and Lein CPAs. The phone number, area code 702-597-1945. And then it's Greg at hilburn-lean.com for an email address. And yes, I'm available.
You got a good reputation for the guy to write things off, right?
You're trying to get me in trouble, Dan. I can't be going out with you anymore.
Also, we'll have his contact on our website, 781nova.com.
So let's go ahead and jump right into, we wanted to talk about zombie foreclosures. And, this is something that it's not a big deal, but it is increasing. And it's something that I wanted to talk about because we've seen that there's been an increase in these here in Las Vegas. And I think with what you got to look at is that, what a zombie foreclosure is. Chuck, go ahead and elaborate on that for me.
Basically what it is, it's where somebody, actually an owner of a property has not been making payments to the property and they're getting foreclosed on. And what happens is they vacate the property early. And at that point, the property's abandoned. Nobody's taking care of the property and it's going through a limbo at this time.
So I think some of the problems here is most homeowners leave the property, are not aware that they're on a hook for some of these fees pertaining to the property. It forecloses. You know, we heard about the robo signings and things like that, and it forecloses. And guess what? They're coming back and they're being hit for fees and things that they didn't pay for when they left the property.
Yeah, you're better off if you're in that situation just to stay in the property and to maintain the property.
Or why not short sale it?
Well, exactly. Sometimes people just get scared and they just take off. But remember, when you do that, you're putting yourself in a bigger liability.
Yeah.
Because if something happens to the home, you're responsible for it. The law says after $5,000, you're responsible for everything.
So I think banks have corrected a lot of these problems. You know, we talked about a little bit about judicial foreclosures, which kind of maybe helped the situation of them proceeding to foreclosure and things like that. But I think with these zombie foreclosures, now they're looking at, well, you know, how do you fix that?
Yeah.
You know, and you got to look at, well, homeowners need to know why it's important to exercise a short sale. They need to know what their, you know, what their options are.
Yeah.
Coming off of being in a foreclosure and leaving. I don't think in any situation, regardless if it's a home that you just leave, that it's never a good thing, especially, you know, credit wise. You know, that's anything pertaining to credit. You just kind of put it out of sight, out of mind, and you just like, hey, I'm not going to do anything with it. You're going to have something come back at you. And I think you got to look at your options. You got to know what's out there. So as we said, there has been a number of homeowners heading to foreclosure, leaving their properties that are going through these zombie foreclosures. And about 34% of Valley homes in foreclosure process right now, but not yet bank owned, have been vacated by their homeowners.
And this affects everybody. I mean, it affects property taxes, affects the homeowners, affects the banks.
Everybody.
It really does. And it affects your neighbors. You
also got to look at right now there's about, I think there's a total of about 1,900 zombie foreclosures, which is up 16% from a year ago. And nearly 24% of homes headed to foreclosure have been vacated by their homeowners. That's roughly 127,000
and according to
zombie foreclosure homes right now on the market. And I think when you look at it, it's still a problem, but it's something that you have to address.
Yeah. And according to Realty Track nationwide, we have over 141,000. Every 1 out of 5 homes are in that situation, at up 21%.
And I think if you look at, well, why, you know, you have people that are, they call them squatters.
Yeah.
You know, where they stay in the home and they don't leave the property and they're just somebody in there that's taking advantage of the system, really.
Yeah.
You know, we've seen a huge increase of those people staying in, but actually a huge increase where they're not having that ability anymore.
Yeah.
And I think it's because banks are coming in and they're expediting the foreclosure process.
Yeah.
So when you're in that position and you're leaving a home, one, you got to do the right thing. You know, I think you got to look at the idea that, you know what, this bank or these banks that are out there giving loans, I get it. You know, you probably maybe were put in a position where you're upside down or something didn't happen to you, but you want to minimize the damages.
Yeah.
You don't want to just leave something because you know what, that indicates to them that you don't care.
And I think part of the problem is that because it's now a judicial foreclosure, which is you have to go to the court to foreclose on a home. I think the process takes a lot longer, and we should have left it as a non-judicial foreclosure because you can get them out within 120 days.
Yeah, and one of the things and why we're bringing this up is Nevada, with the bulk of its population here in Clark County, has now become the 4th highest zombie foreclosure rate in the nation. 1 in every 495 homes among states with more than 100 properties in foreclosure. That's a big number. And we try to get things on the show just to make you aware of what's going on out there in the market. And I'm going to tell you that when you look at the idea that if you're in this position, call Chuck, 781-6682, maybe get some options if you're the homeowner about maybe short selling your house.
And we've helped a lot of people out. I mean, we've done short sales. They seasoned it. They're back out with Dan, you know, getting approved, and, you know, they're in a home again. I mean, here's the thing. Real estate is just the game. You got to know the numbers. You got to know how to play the game. And we're the guys that know how to play the game. So call us.
So we're going to go right into the lender versus realtor face-off. You ready for this, Chuck?
Let's do this.
I'm ready for you to start today.
All right. Let's get it going. Here it is. Can a borrower transfer money from a credit card into a personal account to be used as a down payment for a loan?
Negative. We'll just say no, and please don't ask that question again. That's not sourceable income. So okay. No.
So let me ask you this: How does it affect it? Because the underwriter's going to take a look. Okay.
Your debt ratio is going to go up, and then we have to hit you for the debt on that credit card. So why would you do that?
Got it.
It's basic. It could put you in a position to not qualify for a home. So let's say you have a deal fall out that's FHA, and I know that an appraiser stays with the property for 120 days. I don't know if you know that. Do you have any issues getting the appraisal back from the property? Let's say if they did fall out from the buyer.
Now, let's say if it fell out from the buyer. Now, the buyer, because he paid for it,
right,
they have a right to give it to us or not. But typically what happens is when we go under contract, my buyers are going to go ahead and, pay for the appraiser, and that appraiser is going to pull it up, and he's going to find out, hey, there's a case number attached to it,
right, and
he's going to pull that file anyway.
Right.
But unfortunately, my client has to pay for it, but it is the other buyer's option to hand it on over to us.
And as a lender, I can transfer that case number. So let's say he went with a different lender. Now he wants to come to me. Well, I could take that case number and put it onto this loan and use that appraisal. It actually expedites the loan process a little bit quicker.
Now, if I wanted to buy a fourplex, can I actually use that rental income towards my debt-to-income ratio?
Yeah, you can definitely use it. Now, here's the thing. There's certain ramifications on a fourplex. Now, if you're renting one of the properties, like one of the units out, there's a different calculation that you got to go off of. There's also different debt ratio and things that I got to look at. So it's very important to give me a call outside studio to tell you about that, because it's not the same. You can still use it, but you're looking at it differently.
So it's case by case.
It's case by case, very, very much. When you're representing a buyer, Chuck, how many times do you have an issue with lights and fixtures not being in working order during the process of your loan?
That happens quite a few times, and if it does, we just request the seller to fix it, and we want to get all those things up and running before we actually do the inspection. And usually the seller doesn't have a problem getting all that stuff done. It's not a big deal. Now, let me ask you this. Mortgage insurance.
Right.
What is mortgage insurance, and how much is it?
Mortgage insurance is to allow you to have down payment and debt ratio options where it's a little bit more lenient. Like Fannie Freddie, they give you mortgage insurance to give you that 5% or 10% down payment. FHA does the same thing. They have their own FHA mortgage insurance that gives them the ability to give you a 3.5% down payment. So really it's put in place to provide leniency to clients so they can get into homes.
So how much more on a payment would that be?
Depends on loan amount, but you always got to look at what is the percentage. Well, right now it's like 0.85 for FHA. And then really conventional, which is Fannie and Freddie, is really off of what your credit score is, debt ratio. So they do a blend. And that's always changing. Okay, so on a conventional loan, you have the option not to have that on there, right? No, well, you can't. If you want to get financing for 5% or 10% or even 3%, you have to have mortgage insurance. But if it's 20%, it won't be on there. If it's 20%, it will not, because the bank is saying, you know what, you're putting down enough or you have enough equity that it's not a big risk to me. So as a listing agent, what happens if a lender is asking you for an extension and you're fine with it? Does that really have a problem with you, though? Let's say if you're like, you know what, I need an extension. Is it a problem for you? Well, the first thing I do is I'll contact the buyer's agent and find out what's going on with the buyer's financial side, as far as, what are the contingencies? What is the time frame? And I can get a general idea and I can explain that to my client. But at the end of the day, I don't make the decision because I work for my client, and the seller will have to make that decision. Well, we're going to jump right into the top 5 free things. Okay. And I want to talk about this. Here's why. We give a lot of free things. And I'm going to tell you that one of the things that I love to give away is a free CMA from you. And everybody thinks, well, everybody gives these away. It's not just giving them away. It's what are you doing that's different, or what is the details of what you're providing to the client that's different? Well, we actually put a full package together, and the CMA stands for comparable market analysis. It will show you what's for sale in contingent and pending status. So that way you have a general idea of what to list your property at or what to submit the offer for. We also give a free appraisal and a free home inspection for anyone that calls in to the show, or let's say they go in and fill out an application, or they call you outside the show. If you tell us you listen to the radio show, you get a loan from me, you get a home from Chakits, we're going to give you a free appraisal and a free home inspection. That's big, because here's the thing. We have a client that we went under contract, down payment assistance program. You pay for the appraisal, I pay for the inspection. She literally got in the home for less than $1,500. That's a big deal. That's a huge deal. And I'm going to tell you, credit services, everybody out there might need help, and we can provide that. It's free. Take advantage of that situation. Regardless of what happens, you'll know, and you'll have options, and you'll have power by knowing what you need to do to get into a home if that's what you're choosing to do. You also got to look at that we give away free consultation. I'm going to say this, okay? You hear a lot of this stuff out there with radio and everybody, hey, it's a free consultation. You know what? If I know what I'm supposed to do and I got guidance and direction, and I don't know anything about a specific field like financing or real estate, it could be anything. That's huge because now I have the blueprint of what I need to do to get there.
Laying down a foundation. That's what we do.
Also, I want to tell everybody what separates me as a lender from some of my competitors. I think some of my competitors out there make it harder than what it is as far as getting home financing. Okay, we have in-house underwriting and funding, which is very efficient. We have, in most cases, the ability to beat the close of escrow date. We, as Nova Home Loans, will provide an online status update report that really is a checklist of things that go on during the course of your loan. That's very beneficial. I never get anybody calling me going, hey, where are we at on this loan?
Docs that title yet?
Docs that title 7 times a day. Hey, the other thing we do is we have a appraisal management company. We had an appraiser last week. Why is that important? There's efficiency behind it. Okay. I can get an appraisal back in 3 to 5 days where most companies or competitors takes a 7 to 10 day process. How can I do that? Because we are big enough as Nova Home Loans to have that. We can put who's on that panel list and get your appraisal back, hopefully meeting the value in a very timely fashion. Also, we have 12 bank options, which is really more than anybody I've seen here, but that's big because it provides options to you for financing. We also have a Tuesday status call update, and that's provided by me. If you're doing a loan with me, you're going to get a Tuesday update every single Tuesday, just as well as getting those checklists. And that's important. If I'm calling you going, you know what, this is an issue, we have to fix this, you're going to know about it regardless of what happens. And I think that's a good thing because there's communication involved.
And you're constantly watching the interest rate too as well, right?
Constantly watching it. You know, I told you refinances, you know, it's such a big deal right now because it's so much on the fence that you really got to pay attention to when that, you know, to lock in that interest rate. Because I'm going to tell you that some cases, like I said, it doesn't make sense. And now they got to get low enough. We improved by 1/8 of a point. But, you know, for some of my clients, we really need to improve a lot more to even consider doing a refinance that's called in. So again, it's not for everybody, but I would still look at the idea of exercising that option. And, you know, if you want a free mortgage assessment on your current loan, or if you have any questions regarding financing or real estate, we highly recommend you to call Outside Studio. Again, I'm going to push this number, 781-6682. That's 781-NOVA. Remember, we put this show together to make you guys smarter home buyers and smarter home shoppers. This is Dan French from Nova Home Loans, and I will talk to you next week.